Have you ever wondered why some industries seem to thrive while others struggle? It's not random. It all comes down to the business cycle. Today, I'm going to break it down into 4 key phases: early expansion, middle expansion, late expansion, and recession. And more importantly, I'll show you which sectors perform best in each phase so you can make smarter investment or business decisions. Let's get into it. All right, let's start with early expansion. This is the recovery phase. The economy is just starting to bounce back from a downturn, but people are still a little cautious. GDP is growing, unemployment is going down, and central banks are keeping interest rates low to encourage borrowing and spending. This is when businesses start hiring again, and consumers slowly regain confidence. Now, the big question: who benefits the most in this phase? Financial institutions do really well because low interest rates mean more borrowing and lending. Consumer discretionary sectors like travel, retail, and entertainment pick up as people start spending again. Tech companies also thrive because businesses begin reinvesting in software, AI, and cloud computing. Industrials, like manufacturing and transportation, get a boost because companies start expanding their operations. And real estate? That's another winner, since low mortgage rates encourage home sales and commercial property investments. This phase is a great time to jump into high-growth sectors like tech and real estate because they tend to take off quickly once the economy starts moving again. Next, we move into middle expansion, which is the boom phase. At this point, everything is going great. Unemployment is low, wages are up, and corporate earnings are soaring. People feel confident, they're spending more, and businesses are thriving. But this is also when inflation starts creeping in, and central banks might begin raising interest rates to keep things from overheating. So which sectors shine in this phase? Consumer discretionary is huge. People are splurging on luxury goods, cars, vacations, and entertainment. Tech keeps climbing, with AI, automation, and semiconductors seeing massive demand. Industrials remain strong because businesses are running at full capacity, and financials benefit from higher interest rates, which increase bank profits. Energy also does really well, since more industrial activity means higher demand for oil and gas. This is the phase where everything looks fantastic, but if you're an investor, this is also when you need to start keeping an eye on inflation. Things can turn quickly from here. Now we hit late expansion, also known as the inflationary peak. At this point, the economy is running too hot. Inflation is high, borrowing becomes expensive, and business profits start to shrink. Investors start getting nervous, and stock market volatility picks up. During this phase, the best performing sectors shift toward defensive ones. Energy stocks do well because oil and gas prices tend to rise with inflation. Materials like metals, chemicals, and agriculture become more valuable. Healthcare holds steady since people always need medical services and medications. Utilities also become a safe bet because no matter what's happening in the economy, people still need electricity and water. And finally, consumer staples, things like groceries, personal care products, and household essentials, become more attractive because people focus on necessities instead of luxury spending. At this stage, defensive sectors like healthcare and utilities are your best bet. The economy is reaching its peak, and a slowdown is usually around the corner. Then we hit recession, the contraction phase. This is when things take a downturn. GDP shrinks, unemployment rises, and consumer spending slows. Businesses start cutting costs, corporate earnings drop, and stock markets decline. But even in a recession, some sectors remain strong. Consumer staples hold up because people still need food, beverages, and household items. Healthcare stays resilient since medical needs don't just disappear. Utilities continue to generate stable revenues, since everyone still pays for electricity and water. Gold and other precious metals become popular as investors look for safe haven assets. And discount retailers, think Walmart, Costco, and dollar stores, actually thrive because people shift their spending habits toward budget-friendly options. This is the time to go defensive. Focus on stability rather than growth. If you're investing, avoid high-risk assets and look for industries that people rely on, no matter what's happening in the economy. So, how can you use this information? If you're an investor, rotating your portfolio to match the business cycle can help you maximize returns and minimize losses. If you're a business owner, knowing where we are in the cycle can help you make better decisions about hiring, expansion, and cost management. And if you're just curious about how the economy works, well, now you know exactly why some industries boom while others struggle. That's it for today. If you found this helpful, make sure to like and subscribe for more insights on finance and investing. And let me know in the comments, what phase do you think we're in right now? Let's talk about it. See you in the next one.